Hello everybody, welcome. Today I'm going to walk you through a quick example of how we can apply the CAPM model. And we're going to use the single factor CAPM model, and also we're going to walk through an example using the three-factor model, which is not only going to have the market risk premium factor here, but also the small minus big, high minus low factor, and these two factors were subsequently brought in by Fama and French. We can find these factors on Kenneth French's website, a really great website where we can publicly find data for these factors and also the market risk premium here. I'm going to show you kind of where we've got those. I've already done a lot of the dirty work and have most of the data on this spreadsheet for us to analyze some different things. But let's walk through some of the variables. Obviously, we have the date here, and so these are going to be dates in the monthly format. So we have dates going from the January 1st, 2009, all the way down until October 2017. So we have approximately 8 years worth of data. The second column here is going to be the market risk premium factor. Okay, so that's the market return minus the risk-free rate, and this factor here you can kind of correspond to this single CAPM model, right? So we can see the market return minus the risk-free rate. So this is going to be the first factor and is the only factor in the single factor CAPM model. This next one in column C here, we have SMB, which stands for small minus big. And so this factor is going to capture the small firm effect that we have been proven to see within return metrics, and an additional factor that Fama and French had added on to the single factor model. And we're going to show you the Kenneth French website where we can acquire some of this data and also learn a little bit more about the small minus big factor. Column D here is HML. That stands for high minus low, and this is going to be a factor that's going to capture the value effect that we see in terms of explaining returns. And so these three factors here are going to be the three factors we're going to put into our subsequent three-factor model once we do the single factor market risk premium model. Column E here is simply going to demonstrate what the risk-free rate is. And so we're going to need to have this risk-free rate because we're going to want to calculate what the excess returns that a fund or an asset has, and we're going to need this risk-free factor here. Again, we get this data also from Kenneth French's website. So let's go to that website and see where we got this data from. Simply, if you go to this web page up here, this is Kenneth French's website. He does a really great job in terms of outlining the different data that you need to run these simple regressions, along with different factors that he has. You can see that it's 3 factors, 5 factors, and also breaks the data down into all these different portfolios of stocks and returns based on all these different factors. So here you can see on the web page the Fama French 3 factors. Okay, these are the 3 factors that we had. If you scroll through this website, you're going to be able to see some of the different factors and different portfolios you have. This is where I've already gone in and done some of the dirty work. Here are the Fama French 3 factors. In this format here, the first format is monthly format, and that's what we're going to be working with. So if you click on one of these and you open this up, you're going to open up a file that looks somewhat like this, going all the way back to 1926. And these are our 3 factors that we have included here. Obviously, I don't need data from 1926. I just needed data from the 2009 period forward. So I've just, simply copied and pasted some of this data into an Excel file. And this is exactly the data we have. And this data is in basis points. And that's an important thing. We're going to have all our variables subsequently before we run the regression in basis points. So this is where we get the data. I'm going to let you kind of explore if you want to in further detail about Kenneth French's website, but this is where we can get a boatload of data. And as you go through here, not only data, broken up in terms of different portfolios based on size and value and other metrics, we also have, breaking down into international portfolios, broken down on different types of factors here. So this is a really great website if you're looking at how to really run an analysis and where to get data for some of those factors you're going to need to run a CAPM model and to decipher, where these returns really coming from. So if we go back to the Excel spreadsheet that we have here, this is where we've gotten these three factors along with the risk-free rate. So we got all that from there. And this F column here, I've really, again, this is from Kenneth French's website here. This is a portfolio and returns on this portfolio that is based on size. And so the first quintile of size, so these are going to be the smallest firms in a quintile basis. These are the return measures that, and again, I've downloaded these. So this would be maybe a portfolio that we're able to put together that is really going to be formed only based on size. So focus mainly on small cap firms and what the returns associated with those small cap firms are. And again, when we look at, and you might have read some literature on this already, that small cap firms, usually see some sort of abnormal return over and above what we see in these large cap type of firms. So, we're going to run a regression first based on this quintile size return portfolio and see potentially where, how we can explain some of these returns. So these are just the returns for that. These are not the excess returns. Now, in order to run this regression over here, and this is kind of the model that we're going to run, in order to run this regression in the single factor model, we're going to see the returns on asset A, or in our case here now, this quintile portfolio is going to be equal to the risk-free rate plus beta, and the first factor is going to be just a single factor, is going to be this market risk premium within our simple CAPM model. Now, in order to run this, we're going to run this, and in order not to get confused between what the risk-free rate is and what alpha is, because it's really what we're trying to find is alpha. Was there any excess returns that this simple portfolio put together can provide us, that maybe a portfolio manager is running some sort of small cap focus portfolio. We can kind of see if there's any excess returns and how those are explained. And if our portfolio manager is charging us a pretty significant expense ratio just to get this small cap type of return that we can acquire from an ETF, then we probably shouldn't pay for that. But back to this factor model here. In order to run this, we're going to have to move this risk-free rate here over to the other side of the equation. So if we take the return on asset A minus the risk-free rate, this is now going to give us our excess returns. And now this is going to be then equal to our intercept term plus our beta plus the market risk premium here. So we have to move the risk-free rate over to the left side of the equation in order to get an accurate reading on what this alpha or this intercept term would be without the risk-free rate. Because remember, what this is saying is the return on asset A should be equal to the risk-free rate plus beta times by whatever this market risk premium is. Right? We should be compensated for that risk. So if we don't move the risk-free rate over to the left-hand side, all of a sudden we're going to get our return, and what we expect to be the alpha is going to be skewed by this risk-free rate. So we're going to move this over, and that's why in column G here, this is going to be the excess returns of this portfolio based on quintile size. Okay, so the smallest quintile here. And so simply all I've done here was I've taken the quintile size here minus what the risk-free rate is. And I've done that for all these different columns here. I've dropped it down. Again, this is a pretty simple Excel function that you can do. And I've dropped this down. Now we have really the dependent variable that we're going to need to run in our analysis. So if we run the analysis, we're going to run a simple regression. All we have to do is go up here to data, look over to data analysis, and here we're going to have our data analysis Toolpak come in. If you don't know how to, or if this regression isn't here in your data analysis Toolpak, you're going to have to add in the analysis Toolpak, and you can go over to File. Excuse me, if you need to add that in, if it's not there, you can go over to File, Options. You can go down here to Add-ins, and you can go through here and add in your data analysis Toolpaks. But I'll leave that for you guys to. Many of you probably already have that added in. If you don't, you can simply Google that and find out some more information. But let's go back to the data analysis. We're going to do a regression. And now what is our regression going to be based off? Well, our y input range, this is going to be our dependent variable. Well, we just said that our dependent variable is going to be these excess returns that we just calculated. So let's highlight this all the way down here. And so our dependent variable is going to be the excess returns. So we have that thrown in. And now our independent variables, okay, so our independent variable, and in this case we're just going to have one independent variable in terms of this single factor model. Right? So this single factor model just has one dependent variable. This is going to be our our market risk premium factor here. So if we highlight that and go downward here, we have our dependent variable, our independent variable within there. Let's just leave the confidence levels at 95%. What does this say? The output lets us go into a new worksheet. So if we hit OK on that, we're going to have this output that corresponds into a new worksheet. And let's just make some of these guys a little bit bigger here so we can see a little bit better. Okay, so we can see here that here's the regression output. The R squared is about 84%. So this one factor explains the variance of returns. Approximately 84% of the variance is explained just by the single factor. And so here, this x1 variable here, this is actually going to be the beta measure on the market minus the risk-free, right? So that's going to be your beta based on that single factor. And so within this beta on this single factor model, we're going to see that the beta corresponding here is approximately 1.28% and very highly significant, right? If we look at whether this beta or this factor is really a significant variable in explaining the variance of returns, we can see yes. I mean, by a very statistically significant margin with a t-stat of close to 24 and a p-value of virtually 0. Okay, so the probability of seeing this beta here at a level of 0 would essentially be 0. Okay, so very highly significant beta. And the intercept term, and this is going to be your alpha term. Right? So in this case here, just on this, if we form this portfolio just based on the smallest quintile of assets within the United States, we would see that actually we would have a negative alpha associated with this. Now, although this alpha is not significant, okay, this would suggest that on a monthly basis we would be taking almost 22 basis points a month of negative alpha associated with this return. Now, like I said, this is insignificant value here. We can see the t-stat, virtually close to 0. And the p-value is nowhere close to being significant. But that's just the single factor model. Okay, so we can just name this sheet here. If we name this sheet, we can just call this single factor, and we'll call this the quintile 1 model. Okay, so that's an output there. Now the question is that if we add in these additional factors, right? So if we run another regression, and just by simply running a regression with a single factor, what if we run another regression with the 3-factor model? So now not only with the explanation of this market risk premium, but now also small minus big, high minus low factor. Does this explain, or can this better explain the return and the variance of those returns by including some of these 2 additional risk factors that we may have when we form portfolios? So simply we're just going to run another regression and we're going to hit OK. And so our dependent variable in this analysis, we're still going to run this on the small quintile portfolio, but now instead of our X range just being one single factor, okay, now all of a sudden we're going to run this on all 3 factors. So if we highlight this box here all the way down and we take those in, same thing, we're going to throw this into another worksheet. We hit OK here. We're going to get another output of regression. Okay, and within here now we're just having one independent variable. We're going to have 3 factors trying to explain these different factors that are associated with with these returns. And so this is simply, again, this is going to be beta of the market minus the risk-free, just like in our previous example. But this is going to be the beta of small minus big. Okay, so some sort of size factor, and this is going to be high minus low, some sort of value factor associated with there. And when we look at these different outputs, we can see, just like in our previous example, the beta, okay, so the beta associated with the market risk premium, again, is going to be highly significant, right? The p-value is virtually 0. But the beta is actually now a little bit less than what we saw in the previous example in the single factor. In the single factor, we had a beta of approximately 1.28, suggesting that, this was somewhat, a little bit more risky than just holding the overall market portfolio. Now when we come back to this new 3-factor model, we can see the beta is actually been adjusted down close to 0. Okay, so that's reflecting some sort of risk with the market, more in line with what the market would see or would return. The next 2 factors on here are going to be factors associated with small minus big and high minus low. So typically there's some sort of return premium given to firms that are small, so small firms, and some sort of return premium given to some sort of value. And we can see in explaining the returns on this portfolio that we formed, both of these factors are significant. So we can see that both t-values are significant and both of these guys are virtually 0. Now the positive coefficient here of 0.014 suggests that this portfolio that we've put together, right, based on this size, smallest quintile portfolio, is actually somewhat tilted towards value stocks within that portfolio. So there's a positive coefficient here, significant coefficient, suggesting that we have some sort of potential value tilt within our portfolio. The next one here in row 19, this beta on really the size factor is a lot bigger than what we saw with the high minus low, close to almost 1 actually, and very significant in terms of our regression, and suggesting that, hey, a lot of our returns can be explained by this size factor, which makes sense because our portfolio, remember, is based off a quintile size slice, and we've taken the smallest firms within it. So this portfolio obviously has heavily tilted towards small type firms that should correspond with some sort of excess return we should have by holding these small type of firms over larger cap firms. So that is a little bit of an example of these 3 factors and explaining those 3 factors. Now again here, the alpha now based off this 3-factor model, again, very close to 0 and still insignificant, right? So if we went back to the single factor, we saw this was, negative 0.22, so negative 0.22 basis points per month, right? So 22 basis points per month, and was very insignificant in the 3-factor model, again, close to 0 now, and still insignificant. So there's not much alpha associated with this type of strategy, especially controlling for these, not only the market risk premium, but these other 2 factors here within the Fama-French 3-factor model. The last thing I'll show you is that the R-squared and the 3-factor model has now gone up to close to 99%, as opposed to the single factor model. The single factor model only had an R-squared of approximately 84%. So you can see that with the 3 factors, this model on an overall basis does a better job in explaining the variance of returns with these 3 factors. So let's go back to the data sheet. And here you're going to see on the data sheet also that we've also added some different also funds here that we can kind of evaluate how well the portfolio managers are these portfolio managers able to produce excess returns, and what is that alpha they're able to produce, whether that's based on a single factor model or a multi-factor model. So I've gone and I've downloaded some data already for us to analyze, and so this was just a simple portfolio that we've based off of a quintile categorization via the via the Kenneth French website. But now these two are actually going to be, this return here is going to be actual mutual fund that manages a fund, and this IPOSX is a fund that manages mainly based off of holding IPOs. Okay, and so they charge close to a 2.5% expense ratio to run this portfolio from you. Now the question is, are these guys able to produce alpha for me, right? Am I able to see excess returns, based on their selection of assets within these mutual funds? So I've downloaded this data, and so here you're going to see these returns in basis points, and just like in the quintile portfolio that we just looked at, I'm going to calculate what the excess return is, because again, we're going to have to separate that risk-free rate over into the left-hand side to really evaluate what that alpha would be. If we didn't do that, remember that alpha would be skewed by whatever the risk-free rate was. So if we look at this and let's analyze, what is there any alpha generated from this type of portfolio? Again, we could just simply go through another walkthrough of what we just did. So we're going to run a regression, and instead of running the regression on this quintile portfolio that we've set up, now we're going to run a regression based off this mutual fund here that focuses on an IPO type of selection. And so if we highlight our dependent variable here, which would be this category, and now we're going to run, let's just run the single factor model first. So we're going to run and select our independent variables here. So if we go back, and now we're going to just run this off a single factor model, so just the market risk premium, and we leave everything else the same, just like we did before, and we hit OK. Again, this is going to give us a summary output here, and when we look at this now in terms of this model, so this is the beta for the market minus the risk-free, that market risk premium. We're going to see the beta associated with this is approximately close to 1 again, highly significant, and alpha actually generated off of this portfolio, once we control for what the return is on the market, market risk premium is actually negative, right? And almost 80 basis points in the negative side per month, right? So the negative alpha here is definitely not what investors like to see, and this is actually significant at the 5% level. Okay, and we can see, and we can compare this to our other models. The R squared for this model is approximately 62%, so 62% of the variance is explained by this single factor here. Now let's compare this to, and we'll run the multi-factor model on this asset or on this portfolio. Now instead of just running the single factor, we'll lose the one factor, and now we'll select all three factors here. Let's see if this can better explain the returns that this mutual fund produces. So everything's the same. We'll throw this into a new spreadsheet. So if we look at this now, we can see the p-values, and again, this is going to be the beta of the market minus the risk-free. This is going to be the beta, the beta on small minus big. This is going to be the beta on high minus low. So now within here, we can see that all three factors are significant. All three p-values are very close to 0. Again, we can see that there's actually a tilt away from value. So there's a tilt towards growth here in this coefficient, this negative coefficient. And this makes sense, right? Because remember, this portfolio is mostly made up of IPOs, which we would suggest probably is more growth-oriented firms. Probably not a whole lot of firms in there that may fall into the value category. Here we have a positive and significant coefficient related to the beta in terms of small minus big. So this makes sense again that in this IPO dominated portfolio, that most of the firms are tilted towards small, maybe smaller market cap firms, and we get a positive coefficient there and significant. And again, the beta here is close to 1 and significant. So, you know, if we compare this beta back to what we had within the single factor model, in the single factor model we had a beta of close to 0.98. In the three factor model, now this beta associated with the market risk premium is still pretty close to that. And again, the alpha generated from this type of portfolio has negative 84 basis points per month, which is something most investors probably won't try to pursue, right? We're looking for this positive alpha instead of a negative alpha. And again, if we compare the overall model to a model just based on a single factor, right? So this one factor model was able to explain approximately 62%. Now when we add in two more factors, the R squared jumps up to close to 71, right? 72%. So this model with three factors are better able to explain the variance of returns associated within there. So if we go back to the data sheet, I also have another value fund in here in which we can run this regression and kind of explain, you know, where the returns are really coming from, whether, you know, we're getting positive value for adding these additional risk factors within there, whether that's on the market side, whether that's, you know, exposed to you know, small cap firms, or whether that's exposed to value firms. You know, this is important to walk through and kind of understand the different factors that may explain returns associated with different portfolios and different assets. So I'm going to leave it off there. If you do have any comments or suggestions, please leave them in the comment box below, and I'll try to get to them as fast as I can. But this is a quick example of how we can run a regression on the single factor model and on Kenneth's French and on his factors that he has loaded onto his website, right? And also there's additional factors that we could put in here. We could put a momentum factor in here. We can put lots of different factors in here to try to explain, you know, where these returns are really come from in the portfolio or in a specific asset. So again, if you like the video, leave a thumbs up. And if you have any questions or comments, leave them in the box below. Thanks for watching.